All right, guys. Welcome to the OnlyFinance podcast. We're in our new office, our new studio. So come by and check us out in Sugarland. I've got Dr. John Osborn with me, PhD, CFP, CFS, CHFC, BCS, AIF. As many acronyms as you want to know, you can find it on John's name. So here we are. So we're going to get right into it. The fun part of what we're here for. Everybody wants to know, when is the stock market going to crash and where's it going?
Well, probably not going to crash anytime soon. Probably. There's going to be the typical corrections. You have, 3-5% corrections per year is on average. You have like 1 10% correction per year, 1 15% correction like every 3 years. Now, you got to remember, in February and June, we had a 19% correction, which is the biggest one since, the 2022 correction, which was a dandy also.
Right.
But we could have another 5 to 7% correction right here, right now. I mean, we've had a pretty decent run, and that's what happens. Sometimes the glass is half full, and sometimes the glass is half empty.
Okay, so for the folks in the world that don't know what the word correction means, what does correction mean in our world of finance?
It's very simple. It's more sellers than buyers, and you could have people think that maybe stocks are too high, or maybe you've made a lot of money. You bought Nvidia at 140, and gets to 180, 190. It says, well, maybe that's going to back off a little bit, and I'll just take my profits and run. And you get enough people that agree with what your thinking is, and that's what you have. Let me make a point. There is a bullish-bearish consensus that is done every week by the American Association of Independent Investors. And every week they come out with a scenario. And they have a long-term scenario, and it's usually kind of comes down to 30% bullish, 30% neutral, and 30% bearish. That's your average. And we're kind of there right now. Okay. Actually, we're a little bit on the bearish side. So when everybody gets bullish, that's when you should probably come out of the market. And when everybody gets bearish, it's when you probably should go in the market.
Right.
To make a point, in 2022, in October, when we were right at the bottom, there was only like 18% people bullish at that point. Everybody else was neutral, mostly bearish. The bearish got up over 60%. Right. When you see those extremes, I'm sorry if I'm nerding out on everybody, but that's what happens when everybody gets bearish. That means they've already sold. And if you've already sold, or if you've already bought, if everybody sold, there's only two things left to do. One is nothing. You just sit there. Right. And the two is to buy. Right. And it builds up the cash reserves. People get a lot of money. And then when the market comes back, it usually comes back with a gusto. It's the only indices when everybody gets less than 20% bullish or less than 20% bearish, that happens that the market is up at least 5% within 6 months, 100% of the time. Right. So far, it's never been wrong. Right. So right now, my point being is that we're in the middle of the road. We're actually a little bit on the bearish side. So nobody can come back and say we're overly bullish right now and the market should have a correction. So I think this can continue, as long as it doesn't run too far, too fast right away.
Right. You always hear that term when there's wailing of gnashing in the streets.
Warren Buffett saying, yeah.
Yep. It's time to buy.
That's when you buy. And then when everybody is happy and everything's rosy and so forth, be aware.
Right.
But, there's still a lot of people pretty bearish out there.
Yeah. And I think rightfully so. Lots of big challenges, especially in, this year already, 19% correction. We got that down. Obviously, inflation numbers have crept up a little bit since February. We got all this talk about the tariffs, all these things that are creating uncertainty in people's minds and hearts, right? Because whether we like to say it or not, most people invest with their hearts and not with their minds.
Exactly right. Right. And I think if you take a look at the obstacles out there, and the one that people talk about the most is the tariff thing, right? Which I am in the camp that says that's way overplayed.
Right.
Actually, I don't think there's going to be a lot of inflation problems from the tariffs. And you got to remember, when they put in the tariffs, so the tariffs go up 15%, that's a one-time only thing.
Right.
It's the tariffs don't go up every year. It goes up, and so there'd be an adjustment to your CPI one time. Okay, now they started the tariffs 5-6 months ago, and if it's not washed over right now, it's not going to be in there.
Yeah, and you got to think every corporation, every person, every individual, their budget is like a balloon. There's only a finite amount of air. You squeeze one end, okay, so maybe we got more expensive, can't say watches, say watches, right? And then you squeeze that in. So then maybe I'm spending less money on watches because that's gotten too expensive. So I got to push my budget somewhere else. But ultimately, we all have the same amount of air, right? And so that's back to our nerd conversation about M2 and money supply, right?
Very good point. Yeah. The tariffs didn't increase money supply. Now, I don't want to go too much an extreme. I'll put everybody to sleep. But right now, the tariffs didn't cause, too much money chasing too few goods. Still, it's the same amount of money.
Right.
So if prices go up on beef, they'll start buying pork and chicken. That's an extreme example, but yeah, you get the idea.
Right.
I just don't think tariffs in the long run are going to be going down. I am in the camp, and we've talked about this in the past. I actually think CPI is going to be steady here and could possibly head down.
Yeah. And I jokingly tell people all the time, I mean, ultimately, the tariffs are more of a negotiating tactic and a kind of bravado situation. But the things that matter, they're not going to put tariffs on. Cell phones, that kind of stuff.
Right.
They're not going to do it on things that matter, right? It's just your plastic swords or whatever going to have a little bit more price. And I will tell you, I bought plastic swords from AliExpress for an event, and they're like, "Oh, there's a tariff charge." I was like, "Oh, maybe I won't buy that."
Yeah, because they can. Yeah.
Right. So, there's a little bit of those things. So, and then you just kind of buy different things, right? Maybe you go, I don't really need swords. I'll just buy, in this example, this was for our event at the movies, the dollar hats that were at the AMC already, right?
Right.
No big deal. So I think when people think about inflation, it is not going up. And the other part of it is the government doesn't want inflation to go up. Why does the government not want inflation to go up? Because your Social Security goes up by the same exact amount.
Well, yeah. Well, and that's a great lead-in, too, because now we've got the Fed decision coming up that everybody kind of knows about, that in September the Fed's going to meet, and that's what we had a recent rally, is that the people said, well, the Fed, Powell, now is leaning to reducing interest rates. I think right now on the chances of, the last poll I saw was 86% chance he's going to reduce it. Now, I'm also in a camp that says, and the way am I saying is, he's not going to reduce interest rates because he has to. He's going to reduce interest rates because he can.
Right.
There's a window open here that's probably going to close pretty soon, but the last numbers that came out on the unemployment unexpectedly jumped up. We kind of think that's kind of a seasonal thing, and it's probably not going to be a long-term problem, and probably that window's going to start closing. So he's going to use that example as, let's go raise interest rates now, or lower interest rates now.
Right, to increase a little bit, right?
Yeah, so that's probably going to happen. And it could happen in December again. So,
While we're on interest rates, let's just clear the air for everybody. Interest rates are not going back to 2s and 3s, right? You're not going to go buy a house at 2.75 anymore. Get that out of your head. If you're going to buy the house. You're going to buy the car. Why? Because, again, if you're old enough to remember, this is normal. Where we are right now is a normal interest rate, right? Just because the last, we'll call it from 2008 until 2021 or so, we've been hooked on this like negative or low interest rate environment because of the back-to-back phenomenon of 2008, which took us 5 years to get out. Then subsequently, maybe 6 or 7 years later, COVID happened, then we cut rates again. So that is not coming back. So don't even think that it is, at least not anytime soon.
excellent point. We think that the Fed eventually wants to get what the long-term average is. Right now it's 4.25. People don't know. and it's probably going to be 4, maybe even less by the end of the year.
Maybe
We think they want to
375.
get to 3.5. We
Okay.
think, I mean, by this time next year, all things being equal, which they never will be, but that's the trend right now, and that's good for equities and everything else that you're purchasing, and good for the federal government.
And slightly good for bonds too, for at least a short run in terms of, values going up, right? Interest rates long term might be good, not be as good, but they're still going to be good, right?
Yeah, it's for those people that have money in money markets. I mean, 9 months ago we were at 5% money markets. Now we're at 4% money markets, and you're get used to being. It's probably going to be down in the 3.5 range, maybe even lower. But the money markets are going to get, who gets excited about 3% interest rate? 5%, I kind of like myself, but 3.
Right, and then also puts another thing out there. A lot of people don't understand that if there's a lot of money in money markets, right? They're sitting on the sidelines, meaning once they start going, interest rates at 3.5, I don't really like this. Where do they go? They got to go to equities to get dividends at 5 from ExxonMobil, or go somewhere else where they can get a little more squeeze out of their dollars. So there's still a lot of money sitting on the sidelines. And the other PSA I would tell people is the most boring thing you can do in the world is go open a money market. I don't know how many times I got to say it on a podcast, but I mean, you're getting 0.01 at Chase. Thanks, Jamie Dimon, and all those other people. 0.01, 0.02. You could get a 400% increase in rate of return on your cash sitting in the bank.
Yeah, again, why do banks pay such a low interest? Because they can get away with it.
Exactly.
Yeah, where are you going to go?
And we stopped paying attention as a society. I think even when I was younger, and probably especially when you were younger, like you paid attention to the bank. You go, oh man, you guys are paying us nothing. You're hooting and hollering, right? Now people are just like, it doesn't matter.
Yeah, yeah. Now again, it's going to be good for companies that are financing purchases. We expect the mergers and acquisition activities going to pick up too. You're just starting to see some of that come in right now, and that's another bit of gas you can throw on the fire, to heat the economy back up a little bit too. Companies start buying out other companies. It gets pretty interesting. You got to remember, there's a certain amount of money out there, and there is a limited amount of stocks on the exchanges.
Right.
You keep getting money goes into it, and when companies, a lot of people don't care about this, and this again, I'm nerding out a little bit, but you have a certain amount of stocks in a stock exchange, and when you have new companies come and start businesses, and you have other companies that buy back their own stock, like Apple's doing and Microsoft's doing, and they're taking that stock off, and it about washes out every year.
Right.
So you have a limited amount of supply, and then you're going to have increased demand. What do you think is going to happen? So that's why we think equities could go up in price too.
Yeah.
Sorry for that.
No, that's
interlude,
okay.
But
and then the other part of it is, there's very few IPOs, right? The IPO market is a little dry.
Little dry right now.
Little dry.
It's
getting better.
Starting to pick up a little bit. And if interest rates come down more and the market goes up, that's when you want to have an IPO coming in.
Right.
People want to, as stocks are going up, that's when you're going to see an IPO go up.
Right. They can see the cash, right? Because now people are starting getting, we'll use the young kids term, FOMO, right? Missing out, right? The fear of missing out, right? You go, oh man, everything is coming up. Nvidia, Palantir, I don't know. You can keep going on and on the big.
So what's it going to do to corporate earnings, man, for next year?
From what you showed me in your newsletter and from the charts that I read, I think corporate earnings are going to do really well.
Yeah.
Go up and continue to go up. And you and I just talked about margins, right?
Yeah.
And how they're doing. So,
yeah, profit margins right now, if they're at 13%, is that high? Yes, it's about a record. So the companies are making more money than they've made like practically at any time in history.
right.
You're making a lot of profits. Now that carries over to earnings. Earnings is, for people who don't understand, earnings are the number one long-term driver of bull markets. The more the earnings they have, the more that the prices go up. And they measure that by, again, this is kind of basic, but it could be rather nerdy. But you have a ratio of price, which is the price in the stock market, and the earnings of the stock market. And that's referred to as price earnings ratio, PE ratio. And that is the one thing that's getting a little overvalued right now.
Right.
It's for the S&P 500, which is what we use as our measurement, our bogey, and that's at around 22, and it's got a long-term history of about 16.8 in that range. So it's a little bit on the high side. But people are rushing into the market because they know that earnings are going to be going up next year.
Right. And then I think the other question people always ask is, as earnings go up, should I just wait?
Well, you might miss the boat. I'm not, and dollar cost averaging into this because a lot of people are saying we're a little high, and yeah, we probably are.
Okay.
You can make that argument. We could have another 5 or 7% correction. You're not going to see it unless we get an outside event, which could. And those they don't advertise. They just kind of show up. They just walk through the door and go, "Hi, we're going to have a housing crisis, or we're going to have a bond crisis, or whatever," and the markets drop, and that will happen. Guaranteed, it will happen.
Right.
Does it look like it's? We don't see it out there right now. We're looking out in the horizon. We don't see any storm clouds that are too terrible.
Right.
There's always stuff on the horizon, but
Now, I want to say differentiate that from, we'll call it things like a war, like Ukraine war or the Gaza situation or any of those, right? The markets generally roll through those pretty easily, right? There's a small kind of blip, but they usually roll through those. Those are different than what you're talking about.
you have to have an event that says, people go like, the Ukraine war, or that could cause the stock market to go down. I go like, is that going to stop you from buying a house? Is that going to stop you from buying a new car? Is that going to stop you from buying the new Apple phone? Probably not. Those events that cause you to not to purchase a house or purchase a car, those are the events you got to be worried about.
Right.
The thing that's going to change your purchasing patterns and so forth. The common sense things. And some people think, I don't know, the price of Bitcoin or some goofy thing's going to cause the stock market to go down. No, it's as long as you got more buyers than sellers.
Ooh, we can segue into something fun: alternatives and digital currency, and just in general,
Okay.
right? You had said earlier, less companies on the stock exchange probably now than ever, right? Just because companies have avoided going public and all the scrutiny and all that stuff that comes with it, right? Is it something that people should be considering? Is adding alternatives, alternatives? I'm not going to use cryptocurrency because that's some places a 4-letter word. So,
Well, probably, and they probably always should be. It's just I don't think this is a special occasion.
okay,
But people will talk about like the 60-40 portfolio. Well, maybe it should be 50-40-10 or something of that nature. There's more out there than just stocks and bonds.
Right.
And some of these things are a little illiquid, but you got to be kind of selective in your alternatives. You just can't buy alternatives because they're alternatives.
Right.
It's like buying a good stock versus buying a bad stock. You got to be selective, and that's why they have financial advisors to help them build that overall portfolio.
Yeah. And I would say that that has democratized quite a bit, right? So when you think back in, as I joke with my kids, back in my day.
My day is a little bit longer than your day.
Your day's longer than mine, right? But back in my day,
They invented stocks, and then I got to work. Yeah.
right? So, those were reserved for the ultra high net worth, right? Ultra high net worth being 30 million plus, right? If you really couldn't touch it if you didn't have, 30 million even,
Right.
But now I think it's become more widely available with the advent of technology and that kind of stuff.
Yes, it has been, and there are new tools and techniques, and the term we use is securitization. But they have made those available. Well, some of these mutual funds and ETFs out there that have billions of dollars have that ability to go buy portions of those things, maybe get 7, 8, 10, 20 of them, and get a little bit of each one of them and package them and have those available for our clients.
Right. Because I'll speak from probably my perspective. You know, the average person, as they grow through their life, probably from 0 to about $1 million in net worth, are just used to public equities, right? Because that's what they can do, right? And then you go from maybe that 2 to 5 million, you're an accredited investor, and you get to 5 million plus, you're a qualified purchaser. But you know, I was talking to somebody recently, and they hit the qualified purchaser realm, and they didn't even realize it. And I said, well, there's so many other things you can invest in other than, you know, just the standard. Here's the S&P 500, which is great. Nothing wrong with the S&P 500. But I think there's lots of other things for them to diversify from.
Exactly. You know, and to take that vein and bring back to diversification, you have big companies like so stop and just go through it, definitions again. S&P 500 is the 500 largest companies out there. Then 501 to 900 is the mid-cap companies, and a lot of those names are big names, and a lot of them you're familiar with. And then you go down to the small cap, and that's like 901 to 1500. There's 600 of those in the index. And, you know, people say, well, we need to buy your portfolios, and I know you do this also, and this is kind of basic, but you buy large companies mostly. Then you have some mid-cap and you have some small cap.
Right.
Those mid-cap and small-cap stocks are undervalued right now.
Absolutely.
They're selling below their normal averages. Everybody wants the Magnificent Seven, the big 7 names. They want the S&P 500, and everybody's forgetting about these other companies that are still making money.
Right.
The problem in the small cap right now, I don't know if you know this, but still to this day, we call them zombie stocks. There's 45% of the companies on the small cap index are still losing money.
Right.
So they, you know, and that number goes up and down. There's always a certain amount, but like in the mid cap, there's only like 6-7%. The large cap.
Yeah, it's harder to buy the index at that range, right? You really got to go and be selective and find the right funds and the right ETFs, the right managers.
You know, some people just buy the S&P 500 and they go from there. You really can't do that in the mid and small cap index. You've got to have good active management down there. You can't use a passive approach. You got to have, and there are good ones and there are bad ones, and that's our business to make sure you get the good ones.
Right, and those are the companies that actually, some of them enter the S&P 500, right? So you think of this year, a new entrance was Coinbase entered the S&P 500.
You know,
A couple others, I forget which ones.
you know, if we won't go there, but did you know that there's not 500 companies in the S&P 500 index right now? It's like 497. They're always adding some and taking them out, and sometimes they take them out and they have a delay putting them back in. So,
Right.
yeah, kind of a fun thing.
Yeah, kind of a fun fact. But yeah, there's a lot of different areas there. So we'll push to figure out what now between now and December 31st.
Yeah. So to kind of finalize this whole talk is that we're looking at earnings and we're looking out the calendar and what we project earnings are going to do. The earnings on the S&P 500 right now, they were expected to be around 265. That's just the number of the total earnings of the S&P 500 to be around 265, and that's what people were looking at for this year. We think it's going to be close to 300, 290, 295 in that range. And that's surprising a lot of people. And that's why some people are buying now, because they anticipate their earnings are going to be higher. At the beginning of this year, we thought the earnings for 2026 were going to be 300. So now for 300, we're looking for 340, 350. Okay, so that gives us
a big number.
If you run the price earnings ratio out and do the numbers, so if earnings are going to be 340 down here, what should the price be? And that's how we look at this. And we're looking at, somewhere between 7,250 to 7,500 for next year. Now we're at 6,500,
Yep.
almost exactly as we're recording this right now. So that's, you could see another 15% appreciation for 2026 on top of the gains that we've got this year. So the sailing is that's where the river's flowing right now. The wind's at your back, not in your face right now. Is it a hurricane? No, but it's a good, let's think of a 10-mile-per-hour breeze. That's at your back right now, and it's kind of smooth sailing, sort of. It will get choppy. We will have storms. Right now, looking forward, it's okay.
We finished where we're at in that 10, 11 range right now. It's going to be pretty interesting because that's not a very normal number. Usually equities are very high, like 22% plus, 21% plus, right? Or they're really kind of down, right? So this 10%, 11% year, while we always talk about the average of the S&P, this is not a normal year.
Right? Well, AI is not normal either.
Right.
I mean, if you kind of look for an example, you have to go back to the dot-coms when they first came, the internet first came out, and all the companies are going to the internet. That was the 90s. And you got to remember that from 91 to 2000, there's a 9-year time period that it went up every year except for 94 when it went sideways.
Right.
We could be on something like that right now. There's danger in getting too bullish, but right now I think that's the path of least resistance.
There's so many new changes coming with AI, so that's a whole nother topic. So
yeah, and we don't
not
really even know how they're going to relate to earnings. We're starting to see some of that.
Right.
It is actually happening. The productivity numbers are going up. We mentioned the profit numbers are going up. These are things that should continue with AI, and that's we're not going to go any further than that at this point.
Yeah, and I would say when you look at the market, and I remember when I was a young man and you showed me how to do a chart, and hit that, do a chart and all that stuff, and you go, okay, well, where are we bouncing towards? And I think the momentum is really swinging towards the uptrend of the market. I do still think bonds are a good place to be. Again, you're going to get still, at least in high yield corporate bonds, get that maybe 7, 9, right?
Yep, exactly. You got to have them. You just got to have them. You just can't say go all equities because that's what hurts you in the long run. You got to have something that zigs when something else zags, and they will zig and they will zag.
Yep. I don't know that. What else is doing well this year? I mean, your large cap values are doing really well this year.
Small caps, mid caps, I said, still suck.
Right.
It's a technical term, folks. When you take a look at the large cap growth, and that's the one that's driving the ship right now.
Right.
And, those numbers are 18, 19% in that one particular category. Small cap growth is, I looked last week, it was -1.
Anemic.
So you could still have a growth company and you're not making any money.
Right, right. So asset allocation matters, diversification matters. End of the year, tax loss harvesting, right? So if you have some non-qualified dollars, take advantage of those. And then money markets. I know a lot of people still got a lot of cash hanging out with Jamie Dimon and friends, right?
Yeah.
And I'm not picking. I actually bank with Chase too. I like Chase. Right.
You're seeing a bit of a bond rally right now too. So it's those people on the 60-40 portfolios, or 60-31, whatever you're using, or 10. There's a little bit of wind in that market too. So it's just not stocks right now.
Yep.
And again, don't forget your alternatives.
Your alternatives got a lot of interesting scenarios and a lot of different things that people probably haven't heard of. And it's just a little bit easier and a little more different for us to help differentiate, right?
Okay.
But other than that, I think that's it, John.
Yeah,
Thanks
I think
for hanging out
we're
with
pushing
us.
up to our time limit here. So
Yeah, awesome. Thanks, Juan. Thanks, everybody.
thanks, everybody.